Well, welcome everyone to our Access to Capital webinar. I'm Nancy Hoffman-Banyak, and I'm CEO of the Greater San Fernando Valley Chamber of Commerce. And I'm excited that you're all here, especially on a federal holiday that maybe you had something else to do. For this webinar, we ask that you mute yourself and if you have any questions, Paula, you want to take them at the end?
I think it's better at the end, yes.
Okay, and you could either put them in the chat or raise your hand feature, and we'll take the questions at the end. I want to introduce our speaker, Ms. Paula Bahamon. She's Vice President of Community Development at Mission Valley Bank, Sun Valley, California. She has spent her career specializing in the support and growth of small to mid-sized businesses. So Mission Valley Bank is a commercial bank, not, what do we call the other one? A regular
retail bank.
Retail bank, thank you.
Yes.
I'm an ex-banker, yet I couldn't remember that, because I was in commercial banking. She has extensive commercial banking experience specializing in small business, business development, and a client relationship management. As a results-oriented banker and with broad-based management skills, she has earned a solid reputation as a skilled and knowledgeable trusted advisor. Her responsibilities also include providing community outreach in an advisory capacity to business owners for financial literacy. And to get started, I just want to turn it over to her. If she wants to tell you more about herself, she can, but let's not waste time on bios and let's learn about how you can get some capital to help your business. So Paula, it's all yours.
Thank you very much. Greater San Fernando Valley Chamber of Commerce. I am a proud member myself and my bank. So I'm here to explain to you, excuse me, what did you say? Oh, she's mute. So I'm here to explain to the audience how to obtain access to capital. And specifically today, like Nancy mentioned, my role as a banker and the institution that I do represent, we do business loans only. So that will be the focus today. I cannot teach you about home mortgage or how to apply for a credit card or vehicle loan or how to consolidate your personal debt. Today, we're going to talk about business lending, how to apply and qualify for a business loan. So let's start by explaining to the audience the type of business loans most commonly known in the banking industry. So number one, it's a conventional loan, and I will explain in a minute what type of loans might qualify under conventional. The SBA, which is a Small Business Administration, it's a government agency created precisely to support the economy in situations of disaster like we have with COVID. We have a lot of SBA loans like the PPP, the Payroll Protection Plan, and the emergency loan. And then we have the state guarantee. So what they do is they provide an extra collateral to the financial institution to enhance the security of the lending requirements. So when we talk about conventional loans, we might have lines of credit, which are meant to work for a short-term period, usually 12 months. And I will explain that in a minute. Another type of loan, it could be for equipment financing, tenant improvements, working capital, expanding your business, buying inventory, buying technology, upgrading your systems, and you need that loan because you don't want to run out of your own savings. You never want to be out of money. You want a cushion. And the third type of loan, it's a real estate, which is a long-term loan. So let's start with an explanation of how the line of credit works. I'm going to illustrate here the mechanics of a line of credit. The line of credit is designed for companies that do have accounts receivable. So as you can see in the image, you will receive a purchase order from your clients. So if you're in manufacturing, it's easier to explain. You need to, as a business owner, you need to buy the raw material, then you need to go and manufacture the product, then you need to assemble it, then you need to package it, then you need to ship it, and then 45 days later, after your client receives the final product, then you will invoice your consumer or your client. So that it's a really long period of time to work with your own money. So the line of credit purpose is a vehicle that will help you pay for your operations while you recover your cash flow conversion cycle. Like I said, usually the mechanics is similar regardless of the type of industry. You can be a distributor, you can be a service oriented, but you receive the invoice, you receive the purchase order from your client, and then it takes time for you to deliver the service and for you to collect. It usually is 45 to 60 days. It's a long period with your own money. So that's when a line of credit comes in place. You use the line of credit to cover the cost of that process for 40 to 60 days. And then when your client pays you, then you pay back the line of credit and you use it again for the same process. It's similar to a credit card concept. You use it, you pay it, you use it, you pay it. Then the next one is the SBA. Like I said, SBA stands for Small Business Administration. It's a government agency which has two programs. One is the loan guarantee, and the other one is the technical assistance. The technical assistance program is where you, as a business owner, can go and have consulting services with an advisor. And the programs are called either Small Business Development Centers or Women's Business Centers. And they even have a program with SCORE, which is retired executives and business owners that are donating time to business owners so they can learn from an experienced business owner that has retired and is passing on to you what the lessons they have learned. The second program is the state guaranteed, the loan guarantee, which will enhance to the bank the collateral for the loan. And the advantage of an SBA loan is that usually has a lower down payment. And like I said, enhance the guarantee to the lender, to the bank, and it has a straight amortization in the case of a real estate purchase. The disadvantage is that it's more expensive, requires more documentation, and requires more collateral. Now, when it comes to commercial real estate loan, that's a long-term loan. Think similar to the purchase of your residence. It's usually 25 years or 20 years or 15 years, so it's a long-term. And when we talk about real estate acquisition, it can be owner-occupied. So I'm going to use the example of a dentist that wants to purchase the space where he or she has the practice. So that's owner-occupied. Or an investment property is the same dentist that has maybe 5 units. The building has 5 units. The dentist uses 1 unit, and the other 4, the dentist leases out to tenants. That's an investment property. With real estate, we also have an apartment buildings. We have multifamily with 5 units or more because it's considered business banking. If it's under 5 units, which will be 4, 3, 2, or 1, it's traditional home mortgage, and that's a different category of type of lending. Remember, here we're talking about business loans. So 5 units or more is considered business loan. Then we have the type of real estate that is retail, like where you have, shops, restaurants, or industrial, where you have warehouses, or mixed use, where in the first floor it's a retail, and usually second and third floor is residential type of dwelling. So in order to qualify for any of these type of loans, whether a line of credit, a conventional loan, or real estate loan, whether it's with the bank or through the SBA or state guarantee program, the underwriters, the financial analysts, will take a look of what we call the 5 C's of credit. And this is the Bible in the banking industry, whether here in California, in Minnesota, or any other state in the United States. The 5 C's of credit are, number 1, cash flow, which means the ability to repay the loan. And actually, I have the explanation in the following slides. Collateral, capital, character, and conditions. So let me explain one by one. The cash flow is the liquidity to pay the daily operations of a new debt. So, you acquire a new loan. Do you have enough income to repay it back? That's the number one. Collateral, it's what is the bank taking in case you as a business owner fail to repay the loan. So is that the building where you have your business? Is that the equipment? Is that inventory? Is it the accounts receivable? Any of those items are considered collateral that we as financial institutions take. The third one is capital, meaning the borrower personal investment or contribution. The borrower is you, the entrepreneur or business owner. Number three will be character. And believe it or not, it's a very important C in the analysis because it talks about the individual, the business owner, discipline to honor your obligations, to fulfill your commitments, and not only from the perspective of your management style in your company, but do you pay your credit cards on time? Do you have any derogatory items in your credit reporting? What does it show the reporting agencies when we pull out the reporting? Have you been in lawsuits? Then why or how? And so the C for character speaks highly about the type of individual the business owner is. And the last one is conditions. So it could be conditions of the market, political conditions, it could be the weather, natural disasters. It's external forces that are affecting the company or the economy to determine if providing a loan is viable or not. It would be a good timing or not. So those are the 5 C's of credit. Then the next item that it's very important for you to understand as lenders, what we want you business owner to have is good management practices. And one of them is having your accounting records, your bookkeeping pristine as possible. So if for those of you that are not in a finance or accounting major, I want you to understand that usually what we want to see it's the type of financial statements that are considered under the general accepted accounting principles, more commonly known as GAAP. And GAAP refers to a common set of accounting rules, standards, and procedures, meaning when I see an accounting report, a financial statement from the bakery or from the mechanic or from the hair salon or from the supermarket, all of them look the same. They're different businesses, they have different revenues, they have different items, but the category, how is illustrated their activity should be consistent. And that's why it's called GAAP. And ultimately, the goal of GAAP is to ensure that the company financial statements are complete, consistent, and they are comparable. So what we want as bankers is when we ask for a financial statement, either to provide it based on GAAP principles, or GAAP is usually for bigger companies, or what is commonly known as income tax basis. And there are 5 types of financial statements that are the same based on these rules, GAAP rules. And one of them is the statement of cash flows. The second one is the most common one, I bet all of you have seen it, profit and loss statement, which tells me how much was your income minus expenses, how much is your net profit. That's probably the most important one. Then the balance sheet, owner's equity, and financial notes. So I want you to pay attention. These are the 5 financial statements that GAAP principles has established as the rules, as the foundation for any business. For a financial institution, for any of these loans that I just mentioned to you, we usually only ask for the profit and loss statement and balance sheet. Those 2 statements give us an illustration of the performance of the company. And based on these two statements, we can determine if you have the ability to repay back another loan, or what is your existing commitment. Are you too leveraged, or do you have enough room to engage in a new commitment and to be able to repay back that loan? It tells us a lot of things, you know, but the most important one, going back to the C of cash flow, C of capital, it tells me where the business is and if the business has the ability to repay and to engage in another obligation. So how does the loan package look like? This is a very standard loan package. It depends on the type of loan, I have to admit it. This is just pretty much like a line of credit or working capital. However, this list does not apply for real estate. Real estate is more complicated. I didn't want it included here for the sake of time, because just the real estate application can take the full hour. But obviously, if there is a real estate transaction, then we need appraisals, reviews, environmental review, third-party reports, and we need to review that the property doesn't have any UCC filing from prior owners. So there's a way much more extensive package. So for a standalone application, this is the list. Usually we need from our applicants 3 years personal and business tax returns, 3 years profit and loss statement and balance sheet, current year interim financial statements, accounts receivable report, accounts payable report, and 2 forms that you have to fill out. Now, the reason why we ask for tax returns and financial statements is because sometimes the numbers reflect different information. Usually the tax return is designed to reduce liability, so the business owner will include anything and everything to minimize the tax liability with the government, versus the financial statement give me the true picture as the total amount of money that is coming to the institution, to the company. How much are you keeping? How much is the extra? Can you afford to have a new loan? So that's why we always ask tax returns and financial statements. So deal or no deal, what do loan officers consider during the evaluation? So number one, like I mentioned, the 5 C's of credit, which is the credit history and applicant's willingness to repay the loan. And then the tax returns, which is an applicant ability to repay the loan. With that in mind, you had to condense the very realistic piece of information as what to expect when you're getting ready to submit your loan application. So you need to determine how bad do you need the money. Do you need a new machine because you need to improve productivity? Otherwise, you're going to lose, your position in the marketplace, and the competition is going to take away your customers. Do you need a loan because you want to move to a bigger space because you have restrictions where you are, your lease expired, and it's time to move to a bigger space, and you have enough for the down payment to acquire your own building? So you have to ponder many situations, not only from the perspective of financial capability, but also the conditions of the market, which is the 5th C of C's of credit, and the cost and benefits. So you're going to obtain a loan because you want to improve the business, because something excellent is waiting for you to happen. So is it worth it? If the rate of return is going to be there? How can you measure if you have all the components, all the ingredients in place to have this level of commitment? So once again, it's the conditions, is your capacity, are you in the right timing with the market, and do you have the cash flow to be able to support the loan?